She spent 30 years in a classroom, saved every spare dollar. Then one stock took almost all of it. Not a scam, not a fraud, a stock that every financial magazine called safe, reliable, perfect for retirees. The stock was AT&T, the phone company, the dividend darling, the one everyone said you could set and forget forever. For decades, AT&T was the gold standard of dividend stocks. Steady, enormous, seemingly unbreakable. Millions of retirees held it. Teachers, nurses, factory workers, people who needed steady income and nothing complicated. Penny put nearly everything she had saved into AT&T shares. The yield was almost 7%, far better than any bank. Every quarter, the check arrived. Every quarter, she relaxed a little more. This was exactly what retirement was supposed to feel like. But something was happening inside AT&T that most investors never bothered to look at. The company was drowning in debt. AT&T had made enormous acquisitions, DirecTV, Time Warner, bets that cost over $150 billion. The deals did not work out, the new businesses struggled, and the debt kept piling higher and higher every single year. And yet, the dividend kept being paid every quarter, like clockwork, giving investors no reason to worry. Until 2022, AT&T announced it was cutting its dividend by nearly 47%, almost in half, overnight. 47%. If you were counting on $1,000 a month from AT&T dividends, you now had $530 instead. And the stock price? It collapsed alongside the dividend cut. AT&T shares lost nearly half their value in the same period. The double punch. Income cut in half, savings cut in half, at the same time, with no warning. Penny had $340,000 saved, 30 years of packed lunches and overtime and saying no to things she wanted. After the dividend cut and the stock collapse, a significant portion of that was simply gone. Not spent, not invested elsewhere, gone. Now here's the part that matters most. The warning signs were there the whole time, hiding in plain sight. Warning sign 1, the payout ratio. AT&T was paying out more in dividends than it was comfortably earning for years. A company paying out 100 cents of every dollar it earns has zero cushion. Any bad quarter and the dividend becomes unaffordable. Warning sign 2, the debt mountain. $150 billion of debt is not a small problem. It is an existential one. When a company carries that much debt, every dollar of profit goes to the bank first. Dividend investors eat whatever is left over. Warning sign 3, the failed acquisitions. When a company bets big and loses big, dividends are always the first casualty. 3 warning signs, all visible, all documented, all ignored by millions of investors because the yield looked so good. The 7% yield was not a reward, it was a signal. The market was already pricing in the risk that most investors chose not to see. This is the hardest lesson in dividend investing. A yield that looks too good usually means the market knows something you haven't found yet. Penny did not lose that money because she was careless. She lost it because she trusted a name without reading the story behind the name. Before you buy any dividend stock, read the payout ratio, read the debt levels, read what the company has done with its big bets. A name you recognize is not a reason to invest, it's just the beginning of the question you should be asking. 30 years of saving, one overlooked warning. Don't let that be your story. See you next time.